Nahid. So what does short mean, first of all?
You ask from me, yes?
Yes, I mean, what does short position mean in an interest rate, in a fixed income instruments?
Being in a short position means when you sell or you must deliver
Okay.
an asset.
Yes, good. So you are selling your, let's say, 1-year bond, let's say next week. You are short in the fixed income instruments, let's say for the next week, right? This means that you are selling your fixed income instruments, your bonds, next week, right? So of course, I mean, the price of this bond will be determined. I mean, you know the price. You are selling, let's say, at the price of 90. Anyway, any price, right? The face value is the 100, and they are selling at the price of 90 next week. So it means that you can calculate the interest rates, isn't it? If you know the price, you can calculate the interest rates, correct?
Yes.
Okay. So if the interest rates goes up, what happened to the price in general?
Decrease.
Goes down, right? So in 1 week time, if the interest rates, the market interest rate goes up, let's say 10% to 15%, our 1-year bond, zero coupon bonds price will go down to 19 to 85, isn't it?
Yes.
So you see the interest rates and the price in a fixed income instruments, the relations. So
yes, understood.
so from your perspective, if you are selling with the 90 for the next week, you are expecting to interest rates go down in 1 week time. I'm sorry, go up. The interest rate go up, price goes down, so you are planning to sell it at a higher price. And obviously you want to sell it at a higher price. So you see the relation between the interest rates and the price. Basically the
Yes.
same thing, like a spot one, but now it's in the forward contract.
Thank you very much.
What the next question, Elchin? What is the purpose of delivery dates? What's the function of? Well, delivery date is the settlement date, isn't it, Elchin? If you are signing a contract, derivative instruments, and any contract, the delivery date, I mean, you will deliver your commitment, basically.
Actually, its name confused me. In the deliver date, I know it's settlement date, but in deliver date, what do we deliver in here?
Okay, let's say it's a gold, right? I mean, you sign a gold contract. So you will deliver gold and receive your money. Or let's say fixed income. I mean, it depends on what you are signing and it depends on the contract. You will deliver what you are, your obligations and receive the money, or vice versa. You will deliver the money and receive the whatever it is. So basically, it will settle on that day.
Yes, thanks. It's clear.
Okay, good. Sixth question in the study question 14. Let me open the Jamalettin's question. Guys, give me a few minutes. Okay, study questions. Question 14. No, Question set 14, question 6. Okay, I'm opening it. This one. Kemalettin, this question, right? In the chat box. Okay. Let me open. Okay, let me open an Excel sheet and let's do it on an Excel sheet. Guys, I'm sharing my screen in a minute. Takes time, I'm sorry. No, why not? Why? I would like to share my Excel sheet, but I cannot. Why not? Anyway, I don't know, guys, but let's do it on a whiteboard. So today you have $1 million to invest, right? And the exchange rate is quoted 1.6 dollar for one euro. So this, okay. So let me write the question here. Oh, here is the question. No, I didn't like it. Let me write here. Guys, I'm sorry, but I have difficulties using this Microsoft Teams. Anyway. Okay, let me stop this sharing the screen. Okay, guys.
Hi, Professor and others. Do you hear me?
Yes. Hi, Cameron. I would like to share my Excel screen, but I couldn't do that. I couldn't find how can I share my Excel screen.
There is a button on the top of the corner, share content, an arrow upward sloping.
Anyway, I couldn't manage it. Anyway, let me do it. Can you please close this whiteboard? Can you do that, Cameron? I couldn't manage to close it, this screen.
I'm trying.
Okay, Jamalettin, let me show you here in the screen. So we have $1 million and the exchange rate is $1.6 equivalent of €1. Okay. So we can calculate how much euro we have with this exchange rates. 1 million divided by 1.6. So the equivalent is 625,000 euro. Right? Correct? Jamalettin. Okay. So let me continue. And also, we know that $2 is equal to 1 pound. So the equivalent is 500 pounds, right? So this is given. $1 million is equal to 500,000 pounds, right? So in our hands, we have, so with this given information, 500,000 pounds should be equal to 625,000 euro, right? So with this given information, this should be the equal. But 1 pound is given as 1.20 euro, right? So from this equivalent, with 1 pound, another bank quoted you 1 pound is equal to 1.2 euro. So this means that 500 pounds should be equal to, if you multiply with 1.2, 600 euro, right? But actually, with the other quotations, there's a 25, right? 25,000 euro differences, right? Then convert this 25,000 differences into a US dollar. Let me do it. So basically, let me find another piece of paper.
Professor, it seems I disabled whiteboard. Can you share now the Excel file?
Excel file. Let me try to share
Oh.
my Excel file.
Okay.
Well, I can only see the PowerPoint. I can only share the PowerPoint. There isn't any option for Excel file.
Because you have to open Excel.
Yeah, I have an active Excel sheet in my screen. Yes, I have. Even I don't have any PowerPoints. I don't know why. It only allows me to open PowerPoint only. Share screen. Okay, let me share my screen. Okay, yes, you're right. I got it. Now I got it. Can you see my?
Yes.
Okay, good. Okay, good. Thank you. Okay, let's do it together here. So we have 1 million. Let me write here dollars. Okay, so the exchange rate is 1.60 dollars. Let me write like this one. 1.60 dollars is equal to €1, right? So this is given. And also $2 is equal to €1. No, 1 GBP. Right? So first of all, let's start converting our $1 million to GBP. $1 million is equal to correct. And convert this GBP into euro, right? So GBP, what's the given euro GBP exchange rates? 1 GBP is equal to 1.2 euro, right? So in that case, should be equal to 1.2 euro, right? Hold on a second. My mistake. Let's do it vice versa. In this case, we end up with a loss. Let's convert our dollar into euro first, right? So 1 million divided by 1.6. So this much euro, correct? Of course, this is wrong. So this much euro, let's convert this euro into GBP. Correct. So with an GBP euro equivalent quotations, then we have this much GBP. Let's convert this GBP into US dollars. This GBP should be equal to this much US dollar, isn't it? We're starting with 1 million, ending with something else. The differences is your profit in terms of US dollars, the maximum profit you can make. Is it okay, Cemalettin? Cemalettin?
Yes, got it. Thank you so much, sir.
Okay. So the next one is, could you please explain what's the difference between the forward and future contracts in terms of frequency of delivery? Okay. Let me stop sharing this one. Give me 1 second. One second, please. Hop. Okay. I'm opening the slides in front of me. Okay, I got it. I have slides in front of me. You remember there is 8 different or 9 different differences between the forwards and futures. This frequency of delivery, if it is forward contract, so at the end of the contracts, the obligation, both parties are delivered the items, I mean money, any items, gold, whatever it is. So it's actually settled, actually delivered, more than 90%. Both parties do that. But if it is a future contract in organized markets, no one is actually wait for the delivery. I mean, they are not waiting for the delivery. They want to hedge themselves against the price differences, price increase or decreases, or manipulate it somehow, if in most cases. And before the settlement day, they close their position. So there isn't more delivery on that day. So everyone in the future contract, I'm sorry, close their position before the settlement date. So the frequency of delivery, that's why in the forward contracts are high, but in the future contracts are very, very low. Mehmet, okay? Question? Okay, next one, Laura. Short put, you are selling the right to sell. Yes, this one is slightly difficult. Laura, you are okay with the long one, right? I mean, long put. Are you okay with the long put?
Yes, yes, sir.
Okay, long put means you are buying right to sell. So buying right to sell, right? So you have right to sell it. You are buying this one. So if someone is buying, means that the other party, the counterparty, should sell it. Sell, right to sell. Okay. Short put means it's your obligation. You have to sell it. The other party, the buyer, decided what to do, either sell or not, but you don't have it. I mean, you receive the premium, it's your obligation, you have to sell it. Right? Let me give you an example with an gold, right? So someone is, assume that paying a premium, let's say I'm paying premium to you, and I would like to sell the gold next week at the price of $2,000 per ounce, right? So I have right, so I'm paying premium to you, let's say $100. So you receive $100. I have right to sell to you at the price of $2,000 per ounce next week. We sign a contract, this is our commitment. So next week, assume that the gold price is $1,950 per ounce, right? I'm deciding I have right to sell to you at the price of 2,000, so it's better for me. So I'm selling to you. You don't say, no, it's an option, I don't want it. Because you receive the premium, you have to sell it, this gold. You have to buy it. I'm selling, you are buying, right? So you have to pay me $2,000 per ounce. Clear question? So of course the premium is your profit, and the price differences between the markets and this contract is your loss, and if there is any profit altogether, you have it.
Okay, thank you. So does that mean that like the short put the person with the short put and the one with the call option, they have an obligation, meaning that they cannot cancel the premium.
Yes, so if it is short, if it is selling, so it's an obligation. So they cannot cancel it. You're right. It's an obligation for one side, Ilgar, because if you receive the premium, so it's obligation for you. If you pay the premium, it's an option for you. I mean, I will say it in Turkish. You know, we have a Nasreddin Hoca, like Molla Nasreddin, and he has a joke. Well, one day, small guys asking for a whistle to the Molla Nasreddin. You know that story? You remember that story? So everyone, all the kids are asking for the whistle, but only one of them pay the price of the whistle to the Molla Nasreddin. And of course, obviously, Molla Nasreddin buy only the one whistle to those guys who is paying the money, right? And the others are asking, why didn't you buy to us? And the Molla Nasreddin says, parayı veren düdüğü çalar. So in that case, guys, if you pay the premium, you have right. If you pay it, you can, right? So yes, any questions? I guess it's clear.
Yes, thank you.
Okay, good. I'm looking for the questions. Shuheyla. Let me. No, here I don't have any calculation right now. Nothing, Nermin. Okay, guys, any question, any other question? Maybe I missed some of the questions.
Sir, can I ask something
Yes.
about short put again? The seller receives the premium, right? It's like selling the right to sell, so the seller receives the premium.
Seller, if you are selling a right, you receive the premium. Yes, correct.
So the seller has the obligation to sell the
Yes,
security.
yes. If you receive the premium, then it's obligation for you. You're right.
And it would be more beneficial for a seller if the securities rose in price, right?
For the seller, well, it depends. I mean, are we talking about the put option?
Yes, short put.
Yes, short put means if the price goes down, the seller has to sell it. I mean, you receive the premium and the counterparty has right to sell at the higher price. So you have to do that. The seller has to do that.
Oh, okay, thank you.
You're welcome. Yes, please. Guys, Elchin, of course. Or Nermin, I don't know how which one. Please feel free to speak however you like.
I have another question about the value of premium, setting value of premium. There is one part, the greater term of expression, higher premium for both call and put option. I didn't get here why higher premium for put option. Could you explain it again?
Where is it? In our slide, is it?
Yes.
Okay, let me open the slide and see. Give me 1 second, please. Takes time, guys. I'm opening my slides. Which slide? Tell me the number of slide, please.
I actually didn't know the number. I saw it when I watched the recording in video.
Okay. Factors affecting the premium, right? The higher the strike price, the lower the okay, should be the slides. Let me share my screen. This one, is it correct? Okay, hold on a second. Right, so in that case, higher the strike price, lower the premium on call option, and higher the premium on put option. So call option means buying an assets, right? You have right to buy an assets. So if the strike price is higher, let's say again gold, the strike price, the gold price is right now is something around 1,900, right? Slightly less. Assume that strike price is 10,000, right? In a 1 week time. So it's very unlikely to reach 10,000 in a week time, right? Well, there isn't any volatility, there isn't any price change in a 1 week time, such a big price change in a 1 week time in the gold history. So that's why the premium on this call option is very, very low. Is it clear, this part? Right. But what about the put option? Put option means right to sell, right? So if you sign a contract at the price of 10,000, it's already in the money. You already made a fortune, right? You already made the difference of $8,000 per ounce. So that's why the premium should be much higher than 8,000. It's already made $8,000. So the premium should be higher than these differences. Right? Ilgar, correct? Okay, the first one is, I guess, is clear. The second one, excuse me, guys, I have received an email. I have to check it. Okay, guys. So the next one is the greater the term to expiration, the higher the premium for both calls and puts. So if it is 1 week, and compare 1 week with a 10-year, with the same example, same gold example. So in 10-year time, it's much likely to reach 10,000 compared to 1 week, of course, in both call and put options, right? So that's why, because of the time, what did I do? Go back. Because of this time, the premium should be high both call and put options. Fatima, I will explain it. Is it clear, the second one? I will explain the first one once again. So there is a positive relation with the time and the premium, because much likely to reach that set level. Okay, clear?
Professor, did you answer Ilgar's question in the chat box? Or if not, I can answer it.
Ilgar's question, which question? I don't remember which one is the Ilgar's question.
Owning a short contract means in the chat box.
Go on, you answer it.
Okay, Ilgar, firstly, you are right. You got the logic correctly, because assume you have a bond and you want to sell it at $1,100 in 2 months. And you expect that interest rates will increase till that time. And you know that if interest rates rise, it means bond spot price will decrease. For example, bond spot price will decrease till $900. But you have a short contract. It means you are shorting this bond. You're right to sell at a predetermined price, spot price. And therefore, you will have a profit in this case. If interest rates rise, you will better off. Or if interest rates decrease, you will worse off.
Okay, let me go back to the Fatima's question. Fatima, assume we are selling a gold at the price of 10,000, right? Put option. We have right to sell at the price of 10,000. And for next week. And the gold price is right now is something around 1,900, right? So next week, the gold price, assume that again, no change or something around 2,000, slightly increased, but still not 10,000, but 2,000, right? So I have right to sell it at the price of 10,000. The actual price, the spot price is 2,000. So next week, 100% sure that I will make 8,000 profit, isn't it? Because I have right to sell at the 10,000, the price is something around 2,000, so I will make 8,000 next week, correct? Fatima, correct question?
Yes, it's clear. Thank you.
Yes, I mean, in that case, the premium should be much higher. And lastly, guys, in this slide, the higher the volatility, the higher the premium. Because if the volatility is too high, means that the price is going up and down, so it can reach your target level much easily, right? The price goes up suddenly, like Bitcoin, right? Double the price in a one night. So it can even double or drop down to half in a 1 day time. So in that case, the premium should be very high because the likelihood of reaching the target level is much higher, right? So these are the factors affecting the premium prices. Clear question, Elçin, Fatima?
Yes, it's clear. Thanks.
Okay, guys, thank you. Yes, any other questions?
Can I ask a question?
Yes, please, go on.
So as we know, euro is always the base currency. So if the exchange rate is given us, like I wrote in the chat part now, in this case, in both cases, does this mean since euro is base currency, we always...
Yes, I know. These problems, I got your points. Right. In questions, in exam questions, I will clearly ask, this is the base currency and this is equal to this much. So you don't, well, you will see like 1 point, I don't know, let's say is equal to, I'm writing. In your exam, you will see something like this, right? So you don't need to worry about which one is the which. So I know there's difficulties, which one is the base currency. In real life, the first one, GBP against euro, GBP is the base currency. When you see GBP air quotation, so it means that GBP is the base currency, right? But in some textbooks, it's vice versa. So I got it. I know, I understand your problems, but in exam, you don't need to worry about it.
Okay, great. Thank you.
You're welcome.
And also one more question about
Yes.
this exchange rate. So if I want to convert my dollar into AZN, I will pay attention to the bid price, right?
Correct.
Okay, thank you.
Like a real life. I mean, if you have a US dollar and wants to convert into AZN, of course you will receive less AZN, right? 1.69, not 1.70.
Yes.
So bid price, you have to sell it to the bank's bid price. You're right.
Clear, thank you.
Yes, guys, any other question? Kamran, can you please, at the end of this session, can you please the recordings with the all students?
Do you mean sending the recording link?
Yeah,
or-
share the recording.
Yes, absolutely.
Yes.
I will do it.
Okay. Guys, yes, ask your questions, speak however you like. You don't need to raise your hands. Just ask your questions.
Sir, may I please address a question?
Yes, go on, Nergis.
It is a bit of a technical one about the open-ended questions during the quiz. If we will be asked to calculate the risks of a standalone risk or portfolio risk, doesn't matter. So we were doing it with Excel. Will it be enough for us to just write the formulas and then just plug in the numbers and write our results from Excel on the sheet of paper? Because if we write everything one by one, it will take a lot of time.
No, yes, it's enough. But please plug the numbers in a correct formula, in a correct way. I mean, so I can follow your calculation. Yes, it's enough. You don't need to show all steps, but you need to show all the formula and the numbers, correct numbers. Exam structure, Gachay, you will have 30 questions, multiple choice questions, 60 points, 1 hour time. The exam will start at 3 p.m. and between 3 to 4 p.m. you have to solve this 30 questions, right? Then starting from 10 past 4, we have 10 minutes break between open-ended parts. Starting from 10 past 4, you will have 3 open-ended questions plus 1 bonus questions, altogether 4 questions, right? If I'm not mistaken, you will have 40 minutes for these 4 questions and 10 minutes for taking the pictures and uploading to your Blackboard account, right? So in 50 minutes time altogether, you need to write on a piece of paper like we did. Write everything on a piece of paper, show all your calculations, take the picture, and send it to your account or to me. Well, actually, 3 questions, 30 points. So if I'm not mistaken, 15, 15, and 10 each questions, 15 in one, 15 in the second, and 10 in the third one, and also 5 points for a bonus question. Altogether 105, 45 will comes from the open-ended, and 60 from the multiple choice part. Behlül, 5 is okay. I already did it. 5 is okay. Zulfikar, bonus question is from the last part. But of course, obviously, you have to know the previous part as well. So it's something like the combination of everything. No, I'm joking. You'll see it. Strike price is given, Yasmin. In our questions, it's given. No worries. Nermin, you remember the differences between the direct quotation and the indirect quotation? You remember?
Yes, Professor. In the direct quote, the location of the speaker is matters, but not sure about indirect.
Okay. Well, in both the location of speakers matters. I'll tell you. 1 second. Right. Let me share my screen. No. This one. 1 second, please. Right, this is our slides, right? Can you see it? So, direct quotation, you are explaining, well, let me, one fixed unit of foreign currency against the domestic currency. So $1 equal to 1.7 manat is an example of a direct quotation, right? So, well, in Azerbaijan, this is the direct quotation. From the US perspective, what's the direct quotation? It should be, I'm writing here, 1 AZN is equal to, let me calculate it, 1 divided by 1.7, 0.5882. 0.5882 USD, right? From the US perspective, this is the direct quotation. So the indirect quotation is the vice versa, right? So this one, the last one, is the indirect quotation for Azerbaijan, for yourself, for Baku, for any investors living in Baku. And this one, the first one, is the indirect quotation in US. Anyone in US. So it's depending on the location of the speaker. If it is equal to one foreign currency, equivalent of the domestic currency is a direct quotation. The vice versa is the indirect quotation. Clear question?
Yes, clear, sir. Thank you.
You're welcome. Okay, gotcha. In open-ended part, there will be a question related to calculating stocks, bond prices, only include the chapter mentions. Yes, Gachai. Well, you're right. You have calculation problems related with the risk and return, exchange rates, and derivatives. Right. Any other guys? Any question? Ilgar, if the market price of a gold is 1,008, right, and the strike price is 2,000, we don't need to exercise. Are we buying? Is it a call or put option? From the perspective of buyer, is it a call or put? Are we buying right to buy or are we buying right to sell? Call option, right? Okay. No, it's meaningless. So you don't need to exercise it. I mean, you can buy from the market with the cheaper price if it is a call option, if you are buying right to buy. But if it is a put option, of course, exercise it. It's right to sell. Then sell it at an expensive price. Okay, clear? Elchin, I have seen are options only for, well, options, well, so it depends on call or put. If you are buying right to buy or right to sell. And of course, the strike price, the differences between the strike price and the spot price, the market price, in other words. So these differences, from your perspective, if it is make profit, do it, exercise it. If not, if there isn't any profit, do nothing. So you have to know the strike price, you have to know the spot price, you have to know, is it a call or put option, right? You have to know you are buying or selling those options, because if you are a buyer, it's an option. If you are a seller, it's obligation. Elgar. Okay, I have seen your questions, Elchin. The purpose of margin, if it is a for future contracts, not a forward, future contract, you have to open an account in an exchange, organized exchange, right? So you have to deposit some amount of money as a guarantee. It's your money, but it's like the guarantee money. If the price goes down against you, if you lose any money, this margin helps the other counterparty I mean, it's against the default of any of the parties. I mean, in some cases, you may defaulted, right? So in that case, this margin helps you, any parties, if any of those parties defaulted somehow, this margin helps the other party, counterparty, to protect against it. Right? And it's calculated on a daily basis. If price goes, against you and you lose your money in your margin account, and the exchange market asks you to put some additional money or close your position. So that's why if you want to keep your position alive, you have to put additional money. And this helps both parties from the default. Okay, şöyle. Well, yes, Elçin, it has to be. It's a compulsory. You cannot do anything else without margin account. You have to put some money to your margin account. So it doesn't matter if it is a long or short. You have to put money, right, to your margin account, because the market may goes against you in both sides. And until the delivery date, you have to keep that money. But at the end of the delivery date, let's say you close your position and there are some money. Nothing happened to your margin account. You put some margins, let's say $500, and nothing happened. At the end of the day, at the end, when you close your position, still you have a $500. It's your money. You can transfer to your bank account. It's not someone else's money. The 500 is still yours. That margin fully.
Yes, thank you. I got it.
Okay, guys. Any other question, guys? Any question, guys? If not, good luck for the exam. Okay, guys, see you on
Professor
27th.
Jamalettin has a question in the chat box. If you,
I cannot see.
I can answer it quickly.
Okay, got it. 8 questions in the study questions 14. Okay, got it. I'm sorry. Let me open the question 8. Okay. Up. This question, right? Okay, let me share Excel sheet. Excuse me, guys. Okay, so here the current spot exchange rate is 1.55 USD is equal to 1 euro, right? So this is given right now. And the 3 months forward rate is, so 3 months forward rate is 1.50 USD equal to 1 euro, right? You enter in a short position with a 1,000 euro 3 months forward. So you are selling one, so, right? So it means that you are selling euro and receiving USD. Tell me the amount. Receive how much USD you will get it with the 1.50, of course. $666.67 USD. Correct? With this exchange rates. Jamalettin, okay?
Sir, instead we have to multiply with 1.5 to 1 euro.
Yes, you're right. You're right. You're right. I'm sorry. You're right, because 1 euro is equal to 1.50. Right. My mistake. Thank you very much. Right. So in your hand, so you will have this much 1,500 US dollars. I mean, you sign a contract, you will sell 1,000 euro and receive 1,500 US dollars. Correct? In 3 months. 3 months later, so we don't need the spot rate. We don't need it. I mean, we don't need it. 3 months later, the exchange rates is 1.60 USD is equal to 1 euro, right? So on that day, let me make it different color. On this yellow day, right, we have this much USD in our hand, correct? If you convert it, this 1,500, let me write here, with an 1.6 exchange rates, this is your euro equivalent, right? So as you can see, is it profit or loss? Start with 1,000 and with 938.5. Yes. Right. Clear, Jamalettin question?
Yes, got it. Thank you.
Okay, guys. If any questions, if not, thank you. Well, I don't know, Behlul. I mean, I don't know means I'll tell you. For 30 questions, the multiple choice part, I have 60 questions, right? So randomly you may have it. I don't know. There are some questions, some calculation questions related with exchange rates, of course. I mean, might be. I don't know. Well, actually, you have 30. You have to answer 30 questions, Behlul. But I upload 60 questions, so the Blackboard randomly choose 30 of them. Okay. Said that, of course not.
Professor, can I ask a question?
Yes, please.
So, how it is the best way to compare portfolio stocks in the portfolios or standalone stocks? Like we want to compare the risk, what should we pay attention? Like coefficient of variation or standard deviation?
Well, basically, coefficient of variation, because when you compare the coefficient of variation, you remember what the coefficient of variation is?
Yes, it shows the risk per unit of return.
Yes, the risk per unit of return. In other words, per return, per risk, per standard deviation, per return. Anyway, you get it. I couldn't say it, but yes, I mean, basically, coefficient of variation is the key factor here, because both your return and both your standard deviation, or in other words, risk is included inside.
Okay, what about beta?
Beta is the risk of stocks in a portfolio content. So it shows the risk of a single stock compared to the markets. So is it riskier than the markets or less riskier, safer than the markets as a whole? So the beta shows this relation. If it is 1, is exactly the same as the market. If it is less than 1, means that it's less riskier than the markets, because market goes 10%. If it is beta is less than 1, means goes less than 10%, that stock. So it shows the in a portfolio content compared to markets, a single stock.
Okay, got it. Thank you.
You're welcome. Yes, Ilgar, beta is determining the volatility, I mean, the return compared to the market. So we're comparing with the markets. Good luck, everyone. Behlul, thank you. Yes, Elchin, it can be negative as well. The beta can be negative as well. Correct. If it is negative, means that the market goes up, the stock goes down. Laura. Well, expect the required return rate of return based on the model, CAPM model. It's required with a given. Expected rate of return, it's based on the expectation. These expectations, the market conditions, or I mean you remember the boom, it might be 20% boom. If it is 20% boom, the stock may go this much, whatever it is. So based on this expectation, but required is the with CAPM formula.
And also, if expected rate is less than required rate of return, it means the stock is overvalued and it is better to short this stock. Otherwise, if expected rate is more than required rate, it is undervalued stock. You should invest in it.
So the differences between the required and expected is, gives you an additional information. Either you should buy or sell that stock. Thank you, guys. Nice to see you. Nice to be with you. Well, actually, honestly, I don't like the online classes, but anyway, I'll try to do my best. Hopefully, you'll enjoy somehow.
I'm sorry, can I ask a quick question? Come on, you were saying that if it is undervalued, then we must invest in it, right?
If it is undervalued, yes. If it is undervalued, you have to invest it. Correct. I mean, there is a potential.
Okay. Thank you very much. Thank you for the semester also.
Thank you, guys. Well, see you next year. I mean, not this summer, but next year. Hopefully, I'll be in Baku. Thank you, guys. Bye-bye. Have a nice day. Bye-bye. Okay, Cameron, please share this recordings with the students, and
Yeah,
see you.
sure.
Thank Cameron. Thank you very much for the semester. It's great to be with you. Thank you very much for everything.
Also pleasure to me.
Bye-bye.